Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Ian Lyngen joins right now with BMO Capital Markets. Ian, let's begin with first principles. Do you still maintain that out there we will see price up and yield down?
Yeah, I certainly do. I think that the path for 10 and 30-year yields from here is certainly lower. We've seen 4% hold on a couple of occasions, but I think that as quick as or as soon as this weekend, we could see a weekly close below 4% in 10s, which is constructive for the longer term.
Of course, with Ian Lyngen, I had to set up a chart that would make Katie Kaminsky blush.
Okay.
It's log 10-year yield, which is gorgeous back to COVID.
Lisa was just doing that.
You ready? 2 standard deviations down, like an Ian Lyngen direction, is a 3.77%.
That's what we're talking about.
10-year. Can you imagine?
I can refinance the mortgage.
Exactly. Yeah. What does that do to Ian Lingen's mortgage, Paul?
So, Ian, we're sitting here with a 10-year at about 4% here. What is my Federal Reserve going to do here? Assuming they have some data that maybe we don't have, how do you think they're going to proceed over the next 2, 3, 4 meetings?
Well, they do have some data that we might not have. They certainly have models that tell them what the trajectory of the economy was before the government shut down. I think the path of least resistance is 25 basis point cuts in October and December, followed by a pause in January and shifting to quarterly cuts of 25 basis points next year.
All right. So, I mean, how do you think the Fed is looking at this economy here? The inflation, despite the tariffs, seems to be in check here. So do you think their focus is really more so on the labor market?
I think that after the major BLS revisions and this summer's payrolls prints, that the Fed's focus clearly shifted towards the employment aspect of its dual mandate. As you point out, realized inflation hasn't been shockingly high. There has been some evidence of tariff pass-through, but it hasn't been to the point that it's troubling for the Fed. And so I suspect that what the Fed is doing at this moment is they're not as worried about the performance of the real economy today, but they're normalizing rates in anticipation of trouble ahead in 2026.
So, Ian, you're up at CFR with me today. I've been asking people for good questions. You're smarter than mine. What is a question you would ask Christopher Waller, who is on that short list to be chairman of the Fed?
I would be very curious where he sees the combination of neutral and the overall participation of the balance sheet and SOMA in 2026.
Right.
Because if he has a lower gut estimate, let's say 275, 250, I think that would be a shift from the market's thinking. Or if he's at 350 or 325, that's also key information that the market's looking for.
Link that into the balance sheet, quantitative tightening, quantitative accommodation. Link that into the balance sheet debate. This keeps coming up, Paul, with Michael McKee, with Christopher Whalen, and now with Ian Lyngen. I think our audience doesn't know this. I certainly don't. Link the monetary policy rate, Ian Lyngen, into what Christopher Waller and the Fed is doing with the balance sheet.
So currently, the Fed is winding down or reducing its balance sheet, selling more or allowing mortgages and treasuries to mature and not reinvesting them in their entirety. What the messaging from Powell was yesterday was that will probably end in the next few months. So that means we'll reach a stable balance sheet, which should be good for risk assets. It should be good for the real economy. It'll also be good for Bessent's funding needs as he contemplates how he's going to fund the deficit.
Is he going to fund it? Is he going to fund it with short-term paper, or is he going to start? Can you see it now? U.S. 50-year bonds. Sweeney will line up at the show for that. How are we going to fund this deficit?
I think for the foreseeable future, it's going to be funded in the bill market. There's plenty of capacity. There's plenty of demand in the very short end of the curve. And once we get to the second half of next year, presumably, if my forecasts are right, we'll be in a lower rate environment for 10s and 30s. And it's at that point that Bessent might consider increasing borrowing further out the curve.
Ian, long ago, Lisa Bromwich told me I need to focus on the 2-10 spread. I got the 2-year, 350. I got the 10-year at like 4%. So that's 50 basis points of steepening there. How do I interpret that? Is that a good thing?
Well, it's upward sloping, which is good for the economy. It's good for the system as a whole. So it has normalized. It's not as steep as many, ourselves included, would have expected at this point in the cycle. The Fed has already told us they're going back to neutral, which is 3%. I would have expected that we would have seen either 2-year yields closer to 325 as opposed to 350, or a bit more bearishness further out the curve, as there does seem to be some positive momentum lingering in the real economy.
Ian, thank you for the brief. Really, really appreciate it. I'm going to mention you today with Christopher Atwater there. That's smart observation on possibly a static balance sheet at the Fed. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Right now, too quick a visit with Daniel Tannebaum with Oliver Wyman. Dan, I just want to go to the first line of your note, which is just simply, the IMF, IIF meetings, it's just, when are we going to be adults about containing Russia? Give us an update.
No, that's right, Tom. There's at least discussions in the private forum of concern around when will the U.S. finally take action. We've seen a lot of words. We've seen the president express disappointment. We know there's pending Senate legislation that would significantly increase penalties on Russia, but we just haven't used any of them. And so it is leaving our allies, and I was in Brussels 2 weeks ago, feeling like they're left holding the bag without U.S. support.
And Dan, I just, again, reading your note, it just kind of jumped out at me. There have been 0 new sanctions levied by President Trump since returning to office. That kind of surprised me, given what's taken place in Ukraine. What's the feeling in D.C. here?
I think the feeling is a question of why. What is the holdup? The discussions previously, the president said this, that sanctions will somehow impede the negotiations with Russia. I mean, Russia has only increased their aggression since the Alaska summit, which feels like an eternity ago, and with no tangible actions against Russia. The focus has been on pressuring allies to Ukraine, more so than actually pressuring Russia, to stop this war. So it is a real question mark as to what will it take to see actual action.
Is there some feeling within Congress that Congress can just, without the president, go it alone a little bit and impose some sanctions, or do they need the full support of the president?
They absolutely can, and they've done it before in 2017, which was definitely an eternity ago. Congress imposed sanctions without the president's go-ahead. It actually was to ensure that the president didn't lift existing sanctions on Russia. They will not act without him. Thune will not put this bill on the floor.
Dan, let me ask the elephant in the room question. I mean, what is, with all of your experience, including with the Federal Reserve in New York, Dan Tannebaum, how close is President Trump to Mr. Putin?
I mean, that is the million-dollar question. We don't really know. He's clearly shown a view towards the more autocratic leaders as a model that he aspires towards. Now, he's certainly said repeatedly in recent weeks of the continued disappointment, particularly with drone and military intervention in NATO territory, but that is the question. He has not said anything positive about Vladimir Putin recently, so I guess that's a win. But it's hard to understand the calculus here.
I mean, you're one of the few people I know that can actually answer intelligently. So it's a victory in Israel, Gaza. Can the president translate that over to a quote-unquote victory in Ukraine?
I think he can. I mean, let's give the president credit on the Gaza deal. It's something that few others could have really done to bring both Hamas and Israel to the table to come to a deal. I think if the president put his energy into it, used the mouthpiece that he has, joined back with the G7 allies that are trying to curb and get Russia out of Ukraine, I think it would make a difference. And I think it would be something that gets him towards that famous Nobel Prize that he seems so excited about. But he hasn't done it yet. And that is the question, is what will it take to get him off the sidelines?
Dan Tannebaum shortlisted for the Nobel Prize.
Sure, absolutely. Dan, in reality, is everybody just waiting for the president to decide which way to go? Because there are some serious sanctions in terms of frozen Russian assets that could be levied here that could have significant impacts on Russia. But is it at the discretion of the president here?
Well, so that's the one area where the president probably has less influence. The bulk of the immobilized Russian sovereign assets are actually in Europe, and there's been discussions for months, well, for years, but really recently they've escalated within Brussels in the European Commission around what to do with these immobilized assets. Do we seize them? Do we generate a loan off them, which is already a plan, leveraging the interest gained from the matured securities that were held with some institutions in Europe. But the president here, if he said he was supportive, I think it would help the cause. But this is really an issue that Europe needs to solve predominantly.
Dan, thank you so much. In Washington, Dan Tannebaum with Oliver Wyman. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
David Balin, he's the CEO of CIO Capital Group. David was formerly Chief Investment Officer and Global Head of Investments at Citi Global Wealth, so he's been around the block once or twice. Hey, David, a lot of cross currents out there. We like to focus on the fundamentals like interest rates and earnings. But boy, there's geopolitical issues out there. There's just domestic political issues as it relates to tariffs and so on and so forth. When you talk to your clients, what's the message you try to get across?
Right now, we're looking at next year's earnings being up about 10%. We're looking at interest rates coming down a little bit. And we're looking at an extraordinarily resilient economy that's pretty much ignored some of the major news, both the shutdown and also the tariff negotiations with China. But what we're seeing in client portfolios is a little bit more troubling, which is a great concentration in areas like technology. Managed portfolios have large exposures, but then clients have added on more to that. And they've avoided shares, offshore shares, which I think will do well next year. They've avoided healthcare shares, which will do well next year as well. And so really, we want to see people reorient their portfolios a little bit away from tech simply because of the concentration risk that they have, even though we expect earnings to go up in the technology sector. So it's a complacency that we're really most concerned about, to be honest with you.
Okay, so when it comes to portfolio construction, how big of a moat do I have to have around my castle?
Well, it's funny, the 60-40 portfolio isn't going to work so well, but I think that clients don't have enough bonds and high quality bonds in their portfolio. They typically don't have gold. They probably have virtually no or zero exposure to Bitcoin or any digital currency. And as I already mentioned, they don't have much exposure to China tech or even to offshore equities. So there are lots of places where you want clients to reorient their portfolios. And we're talking about a reorientation that could be 12 to 14% of their assets. So it's not a small change that we're recommending for 2026. So
in your outlook there, David, what role do alternatives play? And I think for alternatives for most of us are private equity, private credit, maybe hedge funds, things like that. How do you think about alternatives?
Yeah, I think there are certain areas in the alternative market this coming year that are going to be better for vintages. Like, for example, with the number of lack of exits of private equity companies and with valuations of mid-cap stocks, about 3 turns less than large caps, I think private equity, especially middle market private equity, is good. But the area that we like best is one that's actually harder to invest in, which is early stage venture capital. Companies that are in Series A, even startup equity. And the reason that we like them is that they give you really large returns, but they also give you a second and third opportunity to invest as the more successful companies come out of those portfolios and funds. So we're emphasizing that our ultra high net worth clients lean into that asset class in 2026.
Are most investors on the same page, whether it be retail, high net worth, or institutional?
It's interesting. The retail investors are actually more active. We're seeing, family offices and ultra high net worth clients really focused on what they did in the past. And that's one of the dangers of portfolio management is if they don't look forward and actually change their strategy, they actually are taking on increased risk. When markets have done as well as they have for the last 4 or 5 years, all of these concentration risks build up. And that's what we're seeing. Even as families have become wealthier, even as family offices have done better, the fact is that their portfolios have become far riskier. And that, I think, is underappreciated.
So fixed income here, it feels like fixed income kind of getting squeezed out over the last several years with the strong performance of the equity market. But, how do you think about fixed income allocations? How much credit risk do you want to take on the fixed income side?
Right. So you're hitting upon a critical point. One of the things that's been squeezed out is fixed income. And with rates where they are right now, both in the traditional markets and in the high yield markets, there really are opportunities for people to capture and hold on to very good fixed income rates that are highly likely to come down next year. And you're right, people are very underallocated to that as well, again, as equities have done well. So we want to see clients take on a full slug of that, right, even including municipals in the United States. And that's why we have such a large orientation to reorienting portfolios. And we also want clients to think about their cash balances. The typical client today has more than 8% of their money in cash, earning less than 3%, when they could be earning 4.5%, right, if they actively manage it. And they have too high cash balances and they're earning too little on them. So there's a lot for clients to do in 2026 and getting ready for next year.
David, here's a softball for you. Don't turn it into a commercial, but what happens at the intersection of AI and wealth management?
A lot is going to happen at the intersection. First of all, in terms of benefits to clients, we're going to see clients develop hyper efficient portfolios, right? They need to spend less, for their fund management, for even their wealth management and advice. And they're going to be able to do that by looking at their entire portfolios, using data aggregation, taking a look at where they're just getting index exposure like the S&P or the NASDAQ, bringing that down to the lowest possible cost, and then doing the reallocations we just talked about, right, in a very methodical way. What AI doesn't do well is anticipate some of the market conditions that we actually have right now. That's where you need people, right, to do that job, the CIO part. But in terms of making portfolios efficient, it is just remarkable, right, that the state of the wealth management industry right now is that the typical retail client will spend 1.1 to 1.5% to get asset management services and fund, including their fund costs. And that's ridiculous. It won't be that high in 2 years.
David, thanks for joining us. Always appreciate getting the benefits of your wisdom. David Balin, CEO of CIO Capital Group. I note that Stephen Whiting, formerly of Citi, recently joined David Balin. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
We actually have a guest who really is an expert on this whole energy stuff. Regina Mayer, Global Head of Clients and Markets at KPMG. Regina, I note that WTI crude oil has got a 58 handle. I mean, I think the folks down in your neck of the woods, they're not real happy with that. Talk to us about kind of where oil is now and what does that mean for the economics of the energy business?
Yeah, so it's really interesting because we've got dueling forecasts going on and an attempt to seize the narrative. So OPEC is saying supply demand roughly in equilibrium, IEA predicting a big supply gut. The industry titans trying to say it's short term, it'll work itself out in the medium and long term. My own view is I think we're near the floor. Why do I think that? Cushing is at a 6-year low for inventory, so U.S. based. I do think for shale, we're going to see flat to low production in 2026. We're starting to see more speculative plays. We're moving into more marginal territory. I think that'll put some of the supply off. And we might be even approaching a contango market where we start to see some uneconomic behavior. We're already seeing Floating storage doubled, 20 million barrels to 40 million barrels. Your own colleague Javier Blas wrote actually a really interesting piece about that. So we think it's the floor. So we don't necessarily like WTI at 58. I think it should be comfortably in the mid 60s, and we'll still see really strong growth from energy companies in 2026.
All right, backwardation in contango. One of these days, somebody's going to give me a clear explanation of that. Hey, one of the regional issues we're facing here, Regina, is a debate, a really intense debate over a proposed pipeline that would go from Pennsylvania through New Jersey, through the Raritan Bay, under the water, and to Queens. You know, the governor here for it, the congressional delegation against it. Can you talk to us about where we are in the debate between oil, gas, and renewables?
So right now we have an environment that is probably more friendly toward oil and gas. I shared the story with Tom and Paul earlier this year at an Astros game, and I know he's a Red Sox fan, but for the first time in a long time, I'm seeing oil companies advertise, baseball brought to you by oil and gas. You would not have seen that 2 years ago. So I think that the industry is trying to take advantage of that. I actually think your part of the country would really benefit from more access to natural gas in the New England, New York, New Jersey area. You have propane deliveries that still go house to house with heating oil. And if we had natural gas lines in, we have a ubiquitousness of natural gas, particularly from Appalachia, really close by, relatively inexpensive. So I think we're trying to do more of that. Offshore wind, I think it's being really under an onslaught in this current administration, but we'll still see a lot of renewables investment with solar and onshore wind and other investments. We're still seeing investments in hydrogen, for example, carbon capture, et cetera. So it might be more stealthy, those non-oil and gas moves. And I think that we're trying to capture more of that space. The other thing I would say is the IEA did say 30% of the world's energy will still have to come from oil and gas in terms of the growth that's coming between now and 2050. So we see insatiable energy demand, and we got to use oil and gas for filling a good chunk of that increase.
When you talk to your clients, Regina, I mean, how do they think about, again, you just brought up this forecast we see for heightened demand for energy going forward, whether it's AI or for other sources. I don't know, it seems to me like we're going to need everything, whether it's, fossil fuels, renewables, maybe even increased use of nuclear. I mean, how do your clients think about that?
It's definitely an all of the above strategy, Paul, that we're making investments. They're looking at what's economic and then what might the future look like that I can still consider that might scale and ultimately become economic. In the meantime, you're seeing more exploration and production in other parts of the world for core oil and gas assets while they're still exploring, lithium deposits, hydrogen as a fuel cell alternative. How do we drive more electrical generation and improve the strength of the grid? So they are looking at all of the alternatives and figuring out which ones are going to be the most economic because they have shareholders that they have to respond to.
Hey, real quick, do you think a reckoning is coming for these AI data centers that they want to build out if they're competing, against me and Paul for energy usage as we see our bills climb higher and higher?
It's a really good question. I think we do see an insatiable demand for electricity. The tech folks that I talk to, they talk about Moore's Law a lot. So while we see the hockey stick of energy consumption, there is a lot of work going on to try to make these data centers not so energy intensive. I'm a believer in technology continuing to drive those curves down, and I don't think it'll be exponential growth. I think they'll figure out a way to moderate it.
Regina, great stuff as always. We really appreciate you taking a few minutes to chat with us. Regina Mayer, Global Head of Clients and Markets at KPMG.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.